Yo, what is going on, you guys? It's your boy Jay Chase here, back with another banger video. It's been a really long time since I made a video, so I owe you guys this one. I want to begin saying thank you, because my life has completely changed on its head since starting SoCal Trading Group. I've met so many people that I never thought I would have met in my life, and I've created so much opportunities that, bro, getting to meet people, help them out, learn how to invest and trade has honestly been the most fulfilling thing that, bro, has ever happened to me, especially in my young adult age. It's like finally being able to find something that you love that provides for you. It's probably one of the best feelings you can ever have as a young adult. So I really want to share with you guys a question, or an answer to a question that I've been constantly getting asked by you guys. What is a stock option and how does it make me money? So I don't want to get too definitive. I don't want to get too advanced and overcomplicate it. I just want the normal young 18, 19, 20, 21-year-old, maybe even 30-year-old or 40-year-old, you know, grandma, mom, papa that doesn't know how to use the phone. I don't want to make it complicated and scary for you guys. I want you guys to build an understanding, a knowledge around this, because all of us fear something that we've never experienced or done before. It's normal. I always share this example, right? I don't want to get too far out of context here, but I have to share with you guys because it's a logical approach to understanding why we fear things that we never have done. So I've always shared this story back in Hawaii. When I traveled, I went skydiving in the island of Waikiki, and when I was skydiving, this tandem jump, I'm about to jump 8,000 feet out of the air. My instructor that was riding behind me, leading the jump, his experience around jumping out of a plane was significantly higher than mine. I asked him, how many times have you jumped out of this plane today? He said 8 times. It was my first time in my life. And he's doing it 8 times a day, every single day as an occupation. So of course his fear is gonna be a lot less than mine, being it my first time in my life. So his experience level, it's what gives him that confidence to not fear jumping out of a plane 8,000 feet in the air, and why me, just like any other individual, jumping 8,000 feet out of the air was almost terrified. And that's investing, that's trading. It's just things that we don't understand, that we've never done, that makes it kind of fearful to explore and get into. We always hear the scary stories of the financial losses that incur with taking risk in investing or maybe trading. And yeah, I'm not going to tell you guys it's not there. It is. But it's something that we can all avoid by taking certain precautionary measures, minimizing risk. And while today in options, yes, I'm sharing with you guys kind of the highest form of risk to reward in the stock market, especially when you get into stock options. Extremely high risk depending on how you use it. So I'm gonna go ahead and cover today what is a stock option and how can you use it to make money, and how can you minimize risk, and understanding the different risk portfolios with using certain option trades and how it all works. So to begin understanding what even an option is, you have to understand how it's different than investing. So buying a share in Apple, buying a share in Amazon, that's investing. You're paying a premium of capital, whatever the share cost you, to own the asset for your entire life. So to make this easy for you guys to understand, what is an option contract? Well, an option contract is a contract between you and your broker that gives you ownership of 100 shares of any asset of your choice or any company of your choice until given expiration date. So when trading stock options, there's an expiration date. Yes, you're buying 100 shares at once, but the catch is, it's not going to be as expensive as buying 100 shares to own. You're buying 100 shares to borrow until the expiration date, which is the catch. Yes, it's cheaper than buying 100 shares of, let's say, Apple at $200 hypothetically. That if you wanted to buy 100 shares of Apple at $200 each, you're looking at spending $20,000. But if you want to buy an option contract of Apple till maybe March 20th, you're going to be spending maybe $1,300 or $900. Well, why is there such a big difference in the cost, but I'm getting the same asset? Well, you have a time limit. You have an expiration date where if you make money or lose money, you're not going to own it anymore. So when you're buying stock options, you're not buying to own, you're borrowing to borrow. Well, what's the goal of borrowing these? Why would I want to pay to borrow something? I want to pay to own it, right? Well, there's certain opportunities in the market where borrowing them actually does you more benefit than owning them. Sometimes companies have short-term news, short-term headlines, short-term great earnings reports, great news, right? Ginormous growth. Share prices ramp up rapidly, but buying some shares or sometimes investing in certain companies is just too much money for many investors. But they still want to be a part of these price moves, these short-term gains that these companies are receiving due to maybe new product launches, productive earnings, rising, data analysts, rising price targets. Different components impact how a share goes up or down. Same thing as the way down. Sometimes companies have short-term moves towards the downside, but their long-term plan or their long-term value is still there. So when investors want to take advantage of a short-term move, but they don't want to overly commit with their capital, they go with something called an option contract. Now, if you believe that shares are going to go up in value, you buy what we call is a call option. So when you buy a call option, you're practically and hypothetically buying 100 shares of any company of your choice at this fixed price, let's say hypothetically $100. When it reaches 105 up here at the top, that 105 is a $5 difference from 100. Well, $5 times 100 shares is $500 in capital gains. But guess what? Since you had 100 shares, you made $500. But what if you just only owned one that you would have paid $100 for? You would have only made $5. So there you can kind of see the leverage, the profit gap that options have. An investor didn't take $20,000 worth of capital and liability to see if this price move would have worked for him or not worked for him. He minimized risk by only investing maybe $100 to own the asset, then buying 100 of them upfront with his own money to own them forever. He's just borrowing them to see if his thesis or his belief that the share price will move based on good news going up or bad news going down. So that's how individuals leverage stock options instead of buying assets or truly committing themselves to an expensive purchase of a long-term ownership or shares. So that's essentially a call option. Now, two types of options you can buy: a call option going up or a put option going down. Now, when you're buying a put option, the way that you make money is essentially selling the shares down here, but buying them here at the bottom. So when you're putting an order to sell shares for 105, but they fall down to 100, now you're essentially making that $5 difference. Why? Because you sold them for 105, but you're buying back at 100. Meaning that when you buy back at 100, the owner of the contract that sold you the shares is going to get his shares back, but that $5 difference that you sold them for is now going to be in your pocket. So if you believe as an investor these companies are going to make short-term moves to the upside and the downside, a great way to minimize capital expenditure, or I guess you can say exposure, is by buying option contracts. Because not everyone wants to go pay $100 a share for 100 of them and pay $10,000, especially if you're just getting started in your journey. Not a lot of individuals are going to have that much money. So options is a great tool to allow you to invest minimal amounts of capital but make extreme capital gains. Now, if you do happen to make these gains, right, what do I do next, Jerry? What is the real strategy? Why do people use options? Well, a lot of investors use options to protect their investments, meaning that the companies that they're trading options on, they already are investing in them. So if I'm an investor and I was buying shares for $100, but I know that every time my share price goes up to 105, it's going to sell off. There's always sellers meeting that point of resistance where the share price comes back down. Well, guess what? I'm going to go ahead and protect my asset by buying a put option at 105, protecting my capital gains of $5 that I invested 100 to 105, protecting that $5 gain, but with the put option for when it comes down, my money goes up and not down in value because I protected it using a put option. Now the $500 that I made using the stock option, I'm going to go ahead and reinvest it into my shares and my asset position to essentially grow my position without losing my $5 in share value but capitalizing on the drawdown. Now, in a call option scenario, if I was an investor that bought shares for $100, but I know that I don't have the money to capitalize on maybe a good earnings report or a good partnership or a good news headline that's going to positively impact share price, but I really want to make the money, then I'm going to go ahead and allocate myself towards a call option and allocate capital towards this call option so I can go ahead and leverage less of my money to make more instead of buying maybe 10 shares for $100 and spending $1,000 and only making $50 on a $5 price move. $5 times 10 is 50. Now I'm gonna go ahead and buy a call option for maybe the same price, $900. Now when we from 100 to 105, I'm not making $50. I'm now making $500 because I own 100 shares of them at 100. So using options is a way to protect your investments against drawdown when you feel or see on a chart that there's resistance or high selling pressure at a certain level. Key levels that you guys can get familiar with are demand, resistance, support, and supply. Extreme key levels, I'll cover it more in the next video here on the channel to give you guys more of an intro to understanding technical analysis a bit better. But sticking to the options, right? Investors use stock options to enter the markets and make more capital, more returns on shorter term movements, and that's why they trade them. But many investors, once they make the profits trading, they simply reinvest it, building up their long-term positions because they're following their thesis. Hey, this is what's driving me to invest in this company. This is why I like it. This is why I'm owning it. I'm gonna use trading stock options to take less capital and make more with it to reinvest in my position to continuously ride for the next 3 to 5 years and maybe protect my asset from volatility in the market. So that's how a stock option is used to protect people's investments, and that's how stock options make you money, both when stocks go up and stocks go down. Stock option is always a good tool to use to invest less money and make more, but it's important you use them when your trades are evidence-backed. There has to be something to give you evidence to take that decision, either buying a call towards the upside or taking a put towards the downside. Things like this could be economic headlines, economic data points, political headlines, geopolitical tensions, earning reports, partnerships, just any sales reports, quarterly earning calls. So many different factors could impact if a company is going to go up or down. But make sure you base yourself off of evidence before trading them, because everything is going to be based on the short term. Now, there is different forms of trading. Highest risk of trading is called a day trade. A day trade is a position that you only can own from 6:30 a.m. to 1 p.m. That's why people call it a day trade, because it's the time frame of just one trading day. Now, the next form of investing is still high risk, but not too high. It's called intraday trading. So this is when you're buying a position for Monday, hoping to close at the end of the week by Friday. So you buy this position to make short-term capital gains throughout the week, still giving you time to maybe be wrong on the one day instead of taking a day trade, which would put you at an extreme risk position, to now minimizing it to just a high risk position, therefore allowing you to maybe allow for some drawdown on Monday, but then get it right Tuesday, Wednesdays, and Thursdays, and then take profit. That's an intraday trade. Next form of investing is a lot less riskier using stock options, and it's called swing trading. This is what I advise many beginners start with. It's a little bit more expensive because you're buying more time with the contract, but it's more profitable because many investors probably will get their entries wrong when you're just starting. Now, this gives you, usually a swing trade goes from anywhere from 2 weeks to a full month of the position owning the contract to allow for the capital gains, or maybe some drawdown in the short term, but still coming out profitable in the midterm, kind of at the end of the 2 week or the 1 month movement. This allows for maybe a medium risk approach to stock options, and I highly recommend beginners start with this. Now, a more strategic approach that does cost more money is called leap trading. Leap trades, usually in my eyes, I consider a leap anything from 6 months to the full year, or some investors go out 2 to 3 years. Leap trades are the ultimate form of, you can argue, lowest risk in stock options because of how much time you have with the asset. Now, the percentage gains are going to be lower because you have more time, but it's always just a safer side to buy more time when you have certain setups. A setup is very important that you guys also trade based off your evidence and your setup. I covered the evidence, but now I'm covering the setup. So a setup is when you look for certain changes in price that are dramatic. Either it went up very fast and potentially in the next 6 months it could come back down, or it went down really fast and potentially in the next 6 months or week or day it can come back up. So this is when you run into the next factor of option trading, which is the setup. So when you understand the setup and you know to find and capitalize your trades or your option investments on certain positions of share price, whether it be dramatically towards the downside or dramatically towards the upside, you increase probability than just guessing where it's going to go, if it's just been consolidating or it's just slow buying or weak buying or weak selling compared to strong buying predicting the downward or strong selling predicting the upward. And that's what I teach all of my guys here at SoCal Trading Group, how to identify, set up, base their trades off of evidence to build consistency in the markets and consistently adapt to news headlines, economic data points, and really just stay ahead of the market to give them the best investing advantage. You guys gain a little bit more clarification of how it all works, and I really hope to help as many of you guys as possible. If you like the subject and you want to learn how to make more money starting with investing or trading in the stock market, give me a DM here at SoCal Trading Group 1. I'll be glad to work with as many of you guys as possible. Thank you guys for watching the video. Leave a like and subscribe. Jerry Trades with SoCal Trading Group, over and out.